Welcome to the Deep Dive. We cut through the noise, get right to the heart of things.
Helping you make sense of a world flooded with information.
Exactly. And today, we're zooming in on a company that's, well, a true tech behemoth, but one that often operates kind of behind the scenes. You know, what if the biggest tech players aren't just the flashy consumer brands you see everywhere? What if it's the hidden infrastructure, the stuff powering everything?
That's a great question to start with.
So today we're doing a deep dive into Broadcom Inc., ticker AVGO. We've waded through a lot of financial analysis, business overviews, expert takes.
Really trying to get under the hood.
Yeah, to understand this company's really ambitious transformation. And the big question for you today, does this bold move make Broadcom a smart investment right now?
So our mission here is to unpack what's actually a pretty complex investment thesis. You've got this valuation paradox on one side.
It's expensive, right?
It looks expensive
Yeah.
and significant strategic risks. But then you also see this immense potential. So the goal is clarity, absolute clarity on these opposing views.
Help you understand the whole picture.
And arm you with a well-defined perspective, a plan.
Because there's this real tension here, isn't there? Broadcom's making this huge, high-risk, high-reward move.
Absolutely.
And it's created both, excitement and some deep friction in the market. It's a proper high-stakes gamble.
Definitely.
Okay, so let's unpack this. So let's start with Broadcom's core identity. For years, it's been semiconductors, right? A global leader.
That's right. They operate on what's called a fabless model.
Meaning they design the chips but don't actually build them.
Exactly. They design these incredibly complex high-performance chips, but they outsource the really expensive manufacturing part, mostly to founders like TSMC.
Ah, okay.
And this lets them dominate in these high-performance niches. Think networking switches, their Tomahawk, their Jericho series. They're kind of the backbone of modern data centers.
And here's where it gets really crucial for you listening right now. Broadcom is essentially a key picks and shovels provider for the whole AI revolution.
That's a perfect way to put it, often underappreciated.
Yeah. They supply the essential high-speed networking stuff, custom AI accelerators, ASICs, they call them.
Application-specific integrated circuits.
Right. For the hyperscalers, the Googles, Amazons, Microsofts, the giants building out AI infrastructure.
And the numbers back that up. TD Cowen analysts estimate Broadcom grabbed over, what, $12 billion in AI revenue in fiscal 24?
Yeah, something like a 70% market share in the segments they target. It's huge.
It really is. But then comes this monumental shift we're talking about, this aggressive expansion into infrastructure software.
Driven by that massive VMware deal, around $69 billion.
That's the one. And look, this isn't random diversification. It's very deliberate, a calculated strategy.
Okay, what's the thinking?
The idea is to take their high-margin semiconductor business and augment it, add a large, stable, recurring revenue stream from software.
To smooth things out.
Exactly. To mitigate the ups and downs, the inherent cyclicality you always get in the semiconductor market. Create a more predictable financial profile overall.
And this VMware gambit, as people are calling it, the changes afterwards were immediate and pretty dramatic.
Swift and decisive doesn't quite cover it. Hock Tan's management team moved incredibly fast.
Right. They started selling off parts, like the end-user computing unit, for about $4 billion.
Divesting non-core assets, yeah.
And then they radically simplified the product line. Everything centered around this VMware Cloud Foundation, or VCF.
That became the flagship.
And maybe the biggest shock, they shifted all customers to subscription only.
Yeah.
Just like that. I got rid of over 50 standalone products.
A complete overhaul, like you said.
But that kind of aggressive approach doesn't happen in a vacuum, right?
No, absolutely not. And that's the crucial point. It has created significant friction. We're talking about the existing VMware customer base. Some are not happy.
Understandably.
And this basically opens a window, an opportunity for competitors. They're actively trying to poach those dissatisfied customers.
So it introduces real execution risk for Broadcom.
Considerable risk. And this, for you listening, this is where that sharp confrontation of ideas really starts. Is this bold strategy genius that creates long-term value? Or is the customer backlash going to be too severe, maybe do permanent damage?
Yeah, this isn't just another merger footnote. It feels like a fundamental bet on the future of enterprise IT. Billions on the line.
Exactly.
And it directly impacts how you should be evaluating AVGO stock.
Okay, so the strategy's clear. Bold, risky, but like you said, with a move this big, you got to follow the money. Let's dig into the financials. Because when you first glance at it, that trailing gap PE ratio, It looks really high, like alarmingly high. Suggests overvaluation.
It does. On the surface.
But you're saying there's more to it. What are we missing?
That is the critical question here, and this is maybe the aha moment for some listeners. That GAAP PE is misleading. Terribly misleading, actually.
Because the GAAP earnings, the official accounting profit, it's heavily suppressed by these huge non-cash amortization charges.
The write-offs from all the acquisitions.
Yeah.
Like VMware.
Precisely. It's an accounting requirement, a big expense on the books, but importantly, it's not actual cash leaving the company day to day.
Okay, so it makes profit look lower than the cash coming in.
Exactly. Which is why, to really understand Broadcom's financial firepower, you absolutely have to look beyond GAAP. You need to look at non-GAAP metrics and especially, critically, free cash flow.
Free cash flow. That's the real story.
That's the real story.
And behind that, the revenue story is, well, pretty impressive too, right? Accelerating growth.
Definitely. A 5-year compound annual growth rate around, 15.6%?
Something like that. And the really dramatic jump, obviously, was fiscal 24 and the trailing 12 months, driven by VMware coming online.
You saw infrastructure software just balloon as a percentage of revenue.
Yeah, from about 21% in fiscal 23 to over 47% now, TTM. That's a huge shift in the business mix.
It's massive. And connecting this back, if you look at the statement of cash flows, that's where Broadcom's core strength really shines.
The cash generation.
Prodigious. The company is a cash machine. Cash from operations, free cash flow, FCF, consistent, impressive growth. TTM FCF hit $19.4 billion.
Wow.
And that FCF, it's not just a number on a page, it's the engine. It fuels everything. Aggressive dividend growth, paying down debt, and positioning them for future M&A, it's the lifeblood.
Okay, but what about the other side of the coin, the balance sheet? It must have ballooned too with VMware.
It did, dramatically. Total assets more than doubled from fiscal 23 to Q2 25, mostly goodwill and intangibles from VMware.
Debt. You don't buy a $69 billion company with pocket change.
No, you don't. There was a massive increase in long-term debt. We're talking nearly $70 billion to fund that acquisition.
$70 billion. That sounds like a lot of leverage.
It is, and it highlights the increased financial risk, absolutely. It underscores just how important generating all that cash flow is they needed to service the debt.
Right.
But, and this is key, that powerful free cash flow generation is what allows them to manage this debt burden effectively. It reduces the perceived risk, even with that big number.
So putting it all together for valuation,
Right.
what does it mean?
Yeah.
We got misleading GAAP PE, strong cash flow, but also high debt.
Right. So if you run a discounted cash flow model projecting future cash flows back to today, it suggests a fair value, maybe around $295 per share.
Okay.
And then if you do a relative valuation, compare it to peers like NVIDIA or Microsoft, companies known for growth and profitability.
How does it stack up?
Well, the stock looks rich, no doubt, but maybe not entirely unwarranted given its growth profile and especially its profitability and cash generation.
So based on your analysis, what's the range?
We're proposing a fair value range of, say, $285 to $305 per share. But, and it's a big but, we have to acknowledge those significant execution risks ahead, mainly around VMware.
Okay, so that's the valuation piece. Looks expensive, but dig deeper, focus on cash flow, and it starts to make more sense, though the risks are real. That's the key takeaway for you as an investor here. Now, beyond the numbers, people talk about Broadcom having a wide economic moat. What does that mean in practical terms?
It's about durable competitive advantage. Think of it like a castle moat protecting their profits. It lets them consistently earn high returns.
And where does that come from?
It's mainly from two things. First, intangible assets, all their patents, proprietary chip designs, especially in semiconductors, decades of R&D there.
Okay.
But second, and this is crucial, especially after the VMware deal, extremely high customer switching costs.
So once you're using VMware, it's hard to leave.
Incredibly hard. Think about it. Migrating an entire corporate data center off VMware. It's enormously complex, it's expensive, and frankly, it's really risky for a big company.
That definitely locks customers in. A powerful moat.
It really does. The challenge, though, while the moat is strong, the intensity of rivalry is still high. Very high across the board.
Competitors aren't just rolling over.
Not at all. In semiconductors, you've got NVIDIA, especially in AI data centers, and Marvell is a tough competitor, too.
Right.
But the software side, post-VMware, that's where the battle's really heating up now.
Who are the main challengers there?
You've got rivals like Microsoft pushing their Azure Stack HCI. Nutanix is a big player in hyper-converged infrastructure. Red Hat with OpenShift. They are aggressively targeting VMware's customers right now.
And that's amplified, you figure, by the friction you mentioned earlier, the unhappiness with the new model.
Exactly. That customer dissatisfaction with the new licensing, the subscription shift, it gives these competitors an opening they didn't have before.
Okay, so that leads us right into the risks. What's the single biggest one investors need to watch?
Without a doubt. The VMware integration and customer retention. Those radical changes, the product simplification, the subscription shift, they've caused real disruption and, yes, dissatisfaction.
So the word is churn, customers leaving.
That's the core fear. If a larger than expected number of customers, especially the big high-value ones, decide enough is enough and go through that difficult migration process to a competitor,
It could really hurt the long-term value of that deal.
it could permanently impair it, undermine the whole strategic rationale. That's the central tension playing out right now. That's the #1 risk.
Okay, what else should be on our radar?
Well, there's significant customer concentration. Their top 5 end customers made up about 40% of net revenue in fiscal 24.
Wow, 40% from 5 customers, including Apple, presumably.
Including Apple, yes. That's a lot riding on a few very large relationships. Any shift there could have a big impact.
Makes sense. And then the debt we talked about, that nearly $70 billion, how big a risk is that really?
It definitely makes
Yeah.
the company more vulnerable if there's an economic downturn. It limits their financial flexibility for other moves. That's a genuine concern.
But balanced by the cash flow, as you said.
Balanced by the strong cash flow, yes, but it's still a factor. Then you've got potential supply chain disruption. They rely heavily on TSMC.
Something like 95% of their chips made there.
Around that, yeah. So any disruption at TSMC, for whatever reason, that's a risk.
And the usual suspects, geopolitics.
Of course. Geopolitical and trade risks, especially U.S.-China tensions, are always relevant for a global tech company like Broadcom. And broader systematic risks, a recession hitting IT budgets, interest rate changes.
Their beta is slightly above the market, right?
Yeah.
1.11, 1.1.
Yeah, indicating slightly higher volatility than the S&P 500, so sensitive to broader market moves.
Okay, so putting that all together for you listening, it really means weighing this incredible opportunity driven by huge trends like AI against some really formidable challenges, many of which are, frankly, self-imposed from the VMware integration.
It's definitely not a simple picture, not a straightforward investment case.
So Broadcom really stands at this pivotal moment, doesn't it? A crossroads.
Absolutely. Its future performance, its stock price, it's all going to hinge on this interplay. Powerful growth drivers versus these significant self-inflicted execution risks. High stakes.
What are the potential catalysts? What could make the stock really take off from here?
Okay, #1 has to be AI revenue outperformance. If they continue to lead in AI networking, in custom chips, that serviceable AI market could hit $60, maybe even $90 billion by fiscal 27. Capturing a big slice of that is huge.
Right. The AI tailwind.
Then there's successful VMware integration and margin expansion. This is the big one related to the strategy. If the shift to VCF subscription bundles actually works as planned,
Meaning customers adopted, stick around, maybe even spend more.
exactly. If that happens, it translates into a significant sustained increase in that high-margin recurring software revenue. And that could lead to a fundamental re-rating of the stock by the market.
And there are some early positive signs there.
There are. As of early 2025, they reported that 70% of their top 10,000 customers had already adopted VCF. That's promising, though it's still early days.
Okay, what else?
And third, rapid deleveraging and capital returns. That immense free cash flow gives them a clear path to pay down that big debt pile faster than maybe people expect, and also continue increasing dividends. They have a great track record there, 14 straight years of increases.
Impressive. Okay, but on the flip side, the potential headwinds. We know the main one.
VMware customer backlash. Still the primary risk. If churn ticks up higher than they've planned for, it undermines everything.
And beyond that.
Broader macroeconomic weakness is always a risk. A global recession would definitely hit corporate IT budgets, which impacts both hardware and software sales.
And competitors turning up the heat.
Intensifying competition, absolutely. As we said, rivals are smelling blood in the water, so to speak, and are aggressively targeting those VMware customers right now. They won't make it easy for Broadcom.
So pulling all these threads together, the AI opportunity, the VMware gamble, the financials, the risks, what's the final verdict? What's the recommendation?
Okay, connecting it all to the bigger picture. Broadcom Inc. has truly engineered this transformation. They've become a unique, formidable infrastructure technology powerhouse, spanning chips and software.
So after weighing everything,
After weighing all these factors, the potential upside against those significant risks, our conclusion and recommendation is a BUY.
a BUI rating.
Yes, a BUY with a 12-month time horizon. And we're sticking with that fair value estimate range of $285 to $305 per share.
And just to be clear for everyone listening, why land on BUI despite those risks we spend time detailing?
It really comes down to the belief that the market, even now, might still be undervaluing the long-term earnings power of this combined Broadcom VMware entity.
So looking past the immediate friction.
Looking past the immediate, very real friction. While the risks are significant, you have to look at Hock Tan's track record. He has proven ability to execute these complex, sometimes brutal integrations and extract value. Combine that execution capability with those powerful secular tailwinds. AI, hybrid cloud. It provides, in our view, a strong basis for a positive investment outlook for you.
So it's a calculated risk, but one with substantial potential upside, provided you understand the full scope of this strategic gamble they're making.
Precisely. It requires understanding that gamble.
So a final thought for you to chew on. Given Broadcom's really aggressive, all-in bet on VMware, what part of your life, maybe your business, professional or personal, could benefit from that kind of high-stakes, transformative gamble?
That's a great question.
And if you did take that leap, what would your plan be? How would you manage the inevitable friction, the pushback that comes with any big, bold move?
Food for thought. And exploring these complex issues like we did today with Broadcom, looking at all the angles, that's really how we deepen our understanding, moving beyond just the headlines.
Absolutely. And if you want to stay ahead of the curve, if you want the fastest, most frequent updates on deep dives just like this one,
Covering the topics that matter.
make sure you hit that subscribe button. Seriously, it's the best way to ensure you're always well-informed, getting this analysis as soon as it drops. Thanks for joining us for this deep dive into Broadcom.
Thanks, everyone.
We'll see you next time.